How are you?
Amora, just confirm. I'm now sharing my screen. Just confirm. Can you see my screen from your side?
Yes, sir.
So, welcome to today's session. So let's maybe have a quick recap of where we left in our last session. So in our last session, we were doing a very important standard. That's IFRS. I think that's IFRS 16. We're looking at leasing of assets. So that was the standards that we were looking at in our last session. Let me reduce the screen a bit. Okay, so we're looking at leasing of assets. So let's have a quick recap of some of the things we did talk about in the last session. So IFRS 16, it tells us how we account for a lease. So we are going to look at it from the point of the lessee, the one that is using someone's property. So we did talk about what is a lease agreement. We did also talk about who is a lessee. We did talk about who is a lessor. Then the elements of a lease agreement. For us to say we have entered into a lease agreement, it must have the following. It must have an identifiable asset. It must be for the substantial benefits of the arising from the asset. Then the lessee must be given the power to control or direct the use of the asset. We did also mention that when you're accounting for the lease, you need to account for the right of use asset and a lease liability. The right of use asset is going to be treated as a non-current asset in your books, and the right of use asset is depreciated over the shorter of the lease term and the useful life of that asset. So initial measurement, we also did talk about the initial measurement of the right of use asset. Initially, it's recorded at the cost. Then we depreciate like the same way we do any current asset. Then the lease liability, this is what you are likely to be paying in future. So remember, you get the asset, you get to use it, but you'll be paying the rental. So the lease liability, we are looking at the payments that you are going to be making regarding in regards to this lease that you have entered into. So these payments that you're going to be making, they constitute the lease liability. So they are fixed payments. There is also a residual guarantee where you are guaranteeing the landlord that at the end of the life, where you guarantee the landlord that at the end of the life of the asset, you are going to, the asset is going to come with a certain value. So that is if it is a residual guarantee. So we did talk about payments for the lease. We can pay for the lease in advance. We can pay for the lease in arrears. So we also did talk about the amortization table. If the payment is made in advance and the payment is made in arrears. So we did talk about the amortization table. Then also we did talk about. So now let's get moving. So from there, we now want to introduce something new from what we covered. So hopefully you did work on more questions and you did practice what we were looking at in the last session. So now let's proceed. So we did mention that the lease liability is supposed to be split into current and non-current liability. And part of it is supposed to be treated as a finance cost, which is taken to the income statement. So let's start with a short lease. So let's finish up this standard and we move on to another standard. So A lease can be a long lease, it can be a short lease. So if a lease is said to be a short lease, what form of a lease qualifies to be a short lease? So a short life lease, a short life lease has the following characteristics. For us to say this is a short lease, it has the following characteristics. Number one, a short lease, it can be seen by the period. So it is given for a period of less than 12 months. So you're using the asset for a period of less than 12 months. So it is for a period of less than 12 months. Of less than 12 months. It's for a period of less than 12 months. Then besides that, it is, if its value is normally 5,000 or less. So the value, it's normally of a low value. It is normally of a low value. So the low value, the amount that is given them, maybe we can work with 5,000 or less. So if the value of the asset that we are leasing out, when it is new, if it is worth 5,000 or less, so it is for an asset worth $5,000 or less. So we're looking at the value when it is new, when this asset is still new. Let's think of maybe you're leasing out a laptop. So that can be part of a short lease. You're leasing out something with a value of less than 5,000 when it is still new. So if it is a short lease, how are we going to account for the short lease? So the short lease is accounted for, short life lease, short life leases, or short life lease is accounted for as an expense, is accounted for as an expense. In the similar way, we treat the rent expense. So if it's for a short life, we can just treat it the same way we treat rent expense. No need to apply the detailed IFRS 16 procedures. So there is no need to create the right of use asset. So if the lease is for a period of less than a year, or is for an asset that is a value of less than 5,000, there is no need to create the right of use asset. Maybe we can just add on that. So we treat it as an expense, and there is no need to create the right of use asset and the lease liability. There is no need to create the right of use asset and the lease liability. Now, let's move on. We can also have what we call a sale and leaseback transaction. Sale and leaseback. A sale and leaseback transaction. A sale and leaseback transaction. So for us to say this is a sell and lease back, we sell the asset, then it is leased back. So it's more like we want money today, but we don't have, it's actually a source of finance. I want money, I can sell the asset to you today, you give me money, then I rent it from you. So I have the money, I still have the asset, but it's no longer mine. So you sell the asset and you lease it back. So that's a sell and lease back transaction. So this arises when the firm sells its asset and lease it back So we have sold the asset that was ours and we have decided to lease it back. So for us to say this is a sell and lease back transaction, a sale must have first of all taken place. So it's very important to consider whether a sale had taken place. So for it to qualify, as a sell and lease back transaction, a sale must have taken place. A sale must have taken place. So how do you tell that a sale has taken place? We look at the conditions we can say a sale must have taken place in accordance with IFRS 16. I think that's the standard we're supposed to talk about today. In accordance with IFRS 16. So the transaction must qualify to become a sale according to IFRS 16. The transaction must qualify to be regarded as a sale according to IFRS 16. So if we can say a sale has taken place, so if we have managed to sell the asset and leased it back, how are we going to account for that? Oh, I think before we talk about that, let's highlight that. Where is my mouse there? Okay. Okay, let's highlight that. If the cell, if it does not meet, it does not meet the criteria to be recognized. If it does not meet the criteria to be recognized as a cell, it is then treated as a transfer, not a cell. So we'll talk about the criteria today of when can we say a sale has taken place. When do we say a sale has taken place? Because we're saying this asset was ours and we've sold it and now we're leasing it back. So let's assume a sale has taken place. If a sale has taken place, how do we account for it? Accounting for the sale and lease back. in the books of the company that have sold. So we're looking at us being the ones that have sold the asset, and we are now listing it back in the books of the seller. So in the books of the company that has sold, what are we supposed to do? We had an asset, we sold it, and we are listing it back. So the first thing is, if we sell the asset, we have to de-recognize it from our PPE. It's no longer there as a non-current asset as our PPE. We de-recognize it as our PPE, and we recognize a right of use asset. So the asset is de-recognized, de-recognized from the PPE, and then recognized. The asset is de-recognized from the PPE and then recognized as the right of use asset. So we de-recognize it from PPE and recognize a right of use asset. Then we also recognize the cash received. If we sell this asset, we are going to recognize cash. So cash, we recognize cash received. Recognize the cash received, and also recognize the lease liability. Means now we have to create a lease liability based on the lease rentals we are going to be paying. So recognize the lease liability. We are going to recognize a lease liability. Then if you transfer an asset, sell an asset that you had, then you decide to list it back. Remember, disposal can reside in profit or loss on disposal. So the profit or loss on disposal, profit or loss on the disposal, the profit or loss on the disposal is transferred to profit and loss. The profit or loss on disposal is transferred to profit and loss. Now, let's introduce I said, for us to recognize a sale, it must first of all meet the criteria for revenue recognition. So with that in mind, I want us to introduce the next standard, IFRS 15. IFRS 15 is a very important standard. This one, it was developed from IAS 18 and IAS 11. So this standard tells us how we account for revenue. So IFRS 15 deals with how we recognize revenue. So it's revenue from contracts with customers. So the standard tells us how we should recognize revenue from contracts with customers. revenue from contracts with customers. So under this standard, the key issue is understanding when should we recognize revenue in our books. So the standard is mainly concerned, with determining. The standard is mainly concerned with determining the point at which revenue is allowed to be recognized. When can we say we have made sales? When can we start recording our revenue in our books? So we're looking at what point can we start recording revenue in our books of accounts? Because we have transactions where the revenue is received over a period of time. You're not going to receive all the revenue at once. So at what point is revenue allowed to be recognized in sales? So IFRS 15 has the revenue recognition criteria. So the standard provides a 5-step approach. It provides a 5-step approach to revenue recognition. It provides a 5-step approach to revenue recognition. So the standard says that revenue should be recognized after the following 5 steps. Number 1, for us to recognize revenue, there must be a contract. So identify the contract. You need to identify the contract. You need to also identify the separate performance obligations. Besides identifying the contract, you need to identify the separate performance obligations. You need to determine the transaction price. You need to allocate. You need to allocate the transaction price. Allocate the transaction price to the performance obligations. So for you to recognize revenue, there is a 5-step approach. So we have now 1, 2, 3, 4. So the last one, we recognize revenue when the performance obligation has been met. Recognize revenue after the performance obligation. After the performance obligation has been met. We recognize revenue after the performance obligation has been met. Now, let's look at it one by one. So we are saying, for us to recognize revenue, there is a 5-step approach that you need to consider. So let's start with the first one. For you to recognize revenue, there must be a contract. So identify a contract. So for you to say, I have sold, there must be a willing buyer, willing seller situation here. No one mustn't be forced into the transaction. So for you to recognize revenue, identify a contract. A contract is an agreement. For me to sell is to say I have sold the goods to you. There must be an existence of a contract. So a contract is an agreement between the buyer and the seller. So there must be a contract. That is an agreement between the buyer and the seller. So identify a contract. A contract is an agreement between the buyer and the seller. And the contract must be enforceable. For you to say you have entered into a sale, there must be an enforceable contract. So there must be an enforceable contract. Remember, there are parties that cannot be, that are not contractual parties, like a minor. You can't say you've entered into a contract with a minor. So for you to say the sale has been processed through, it must have been, the contract must be a valid contract. It must be an enforceable contract. What makes this contract valid? So for the agreement to be valid, for the agreement to be a valid agreement, for the agreement to be a valid agreement, number one, both parties must have an obligation to perform. So both parties must be obliged to perform their obligations. So for us to say this is a contract, both parties must be obliged to perform their obligations. So it means they must be bound to perform their obligations. So they shouldn't be in a position to say, I can do it if I want, but they must be bound to perform their obligations. And there must be a commercial substance. If you're not going to be benefiting anything, then it's a donation. So for sales, there must be a commercial substance. There must be a commercial substance. So we should be benefiting. We should be getting a commercial benefit or an intention to get a commercial benefit. Then the rights and obligations of each party, rights and obligations of each party must be clearly stated. So we should know what are the rights and obligations of the parties involved to that contract. So these should be clearly stated. So if these are present, then the agreement, we can say the contract you have entered into, yes, it's likely to be a valid contract. So the contract is likely to be a valid contract. So if there is a valid contract, so in some cases, you can be given, okay, they've entered into this contract, but maybe the other party is a non-contractual party, or there is no commercial substance. So that contract can cease to become a sale. Why? Because there is the conditions for us to recognize it as a sale are not present. So for it to be a sale, the parties must have agreed. After the parties have agreed, we have also mentioned that we need to identify the performance obligations. So we need to identify the performance obligations. There are certain type of sale contracts that have what you call a bundle of sales. So if you are identifying the performance obligations, you are identifying what is it. We are looking at you as being the one that is supplying the goods, the services, and the one that is recognizing revenue. So if they are different performance obligations, it means that you are required to carry out more than one task. Let's say I have sold a motor vehicle together with free maintenance, KD Limited. Sold a motor vehicle with 3-year maintenance. So we've sold a motor vehicle and would provide free maintenance for 3 years. What have we sold here? We have sold two things. We have sold a motor vehicle and we have sold maintenance. So we have sold a motor vehicle and we have sold maintenance. So this one is a bundle of sales. There is more than one performance obligation. So what we are required to do is not just delivering the vehicle, but also providing the maintenance. So a bundle of sale, a bundle of sale A bundle of sale is a contract. It is a contract with more than one performance obligation. A bundle of sale is a contract with more than one performance obligation. So you are required to deliver more than one thing. So when recognizing revenue from a bundle of sale, when recognizing the revenue from the bundle of sale, when recognizing revenue from the bundle of sale, the revenue must be separately identified. The revenue must be separately identifiable or identified. We should recognize the revenue separately. We have sold two things. Of course, we have said it's free maintenance to the customer, but to us, we have actually made a sale. We'll talk about that. So we have two things that we have sold here, a motor vehicle and maintenance. So Let's move on. So in a contract, your obligations, that's what you have to do. Some of the obligations can be expressed, some of them can be implied. So the express terms, these are what is clearly stated in the contract. So the obligations can be clearly stated. That is express, or they can be implied obligations. So implied, what can give the obligation, what can cause an obligation to be implied? Maybe it's our company's policy. We have not stated it in the contract, but it has been the company's policy. So it means the customers buy from us with the view that we are also going to do what we have been doing for the rest of the people that are buying from us. So we might have an implied obligation. Then you can be selling on behalf of another person. Let's say you are acting as an agent. If you are acting as an agent, it means you are selling something that doesn't belong to you. What you're entitled to is commission. So if you are a sales agent for maybe your duty is to find customers that want the vehicles. The company says it sells the vehicle and maintenance, but your duty is just to find the customers. So the obligations do not arise to you, but they arise to the one that is the owner of the vehicle. So we are saying if the firm is acting as an agent, if the firm is acting as an agent, the obligations remain with the principal. Remain with the principal. The firm only recognizes commission. So if you're acting as an agent, what you are only entitled to is commission. We don't recognize the total of what you're going to receive. So you're acting as an agent. You can sell something for 20,000, but your commission is 10%. What you only recognize is your 10% commission. So even the other, the obligations, if there are other performance obligations, they are not your issue. So you only consider your 10% commission. So if there's maintenance, it is the parent that will provide the maintenance. So let's move on. So we are saying in a sale transaction, there can be more than one obligation. So you can be required to perform more than one obligations. So maybe let's have an example to demonstrate. Let's have an example to demonstrate a bundle of sale. So we can say that, let's have KD Limited. So KD Limited is a company. KD Limited is a company that sells cars. KD Limited is a company that sells cars. During the year, During the year, they sold a motor vehicle worth 100,000. They sold a motor vehicle worth 100,000 on 1 July 20, let's just say 2020. The company's policy provides free maintenance. The company policy provides free maintenance for 3 years. If a person buys a brand new car, so it provides free maintenance for 3 years if someone buys a brand new car. Maintenance services are also provided. Maintenance services are also provided to other customers. At a cost of 10,000 a year. At a cost of 10,000 a year. How much should be recorded? How much should be recorded as part of sales? How much should be recorded as part of sales? In the year ending, it said our, okay, let's just deal with January to simplify things, eh? Ending 31 December. Okay, so this is the case we have. So from this case, we are told that KD Limited is a company that sells cars. So we are not an agent in this case. We are the principal. We are the ones that are selling the cars. During the year, they sold a motor vehicle worth 100,000. So we are the ones that have sold. We are not buying the motor vehicle. It's us selling the vehicle. The company's policy provides free maintenance. The company's policy. So there is an obligation. And this one, even though we have not stated it in the contract, but it can be an implied obligation. It's part of the company's policy. The company's policy provides free maintenance for 3 years. If a person buys a brand new car, maintenance services are provided to other customers at 10,000 a year. So what is it that we want to, what is it that is key here? So there are two obligations. Let's start with understanding the obligations here. Let's assume the contract was completed, and which are the obligations? So our obligations as a company is to deliver, number one, to deliver the motor vehicle. That's the first obligation. And the other obligation is to provide maintenance. So these are the two obligations. And providing maintenance is implied obligation. Let's move on. I will be using this example as we move. So we are on step number 2, identify the performance obligations. So we have identified our performance obligations. Then determine the transaction price. That is step number 3, determining the transaction price. Determine the transaction price. So if you're determining the transaction price, so how much is it that we are going to get from the contract? How much are we going to get from the contract? So in this case, the customer is going to pay 100,000. So for both the maintenance and the car, they're just paying 100,000. So that is the transaction price. How much is the customer going to pay? How much is it going to cost? Okay, let's move on. So in our case, the transaction price you can say this is the consideration. This is the consideration the entity expects to receive. The consideration the entity expects to receive in exchange of the goods or services. How much are we going to receive in exchange of goods and services? So the transaction price can involve what is to be paid now or what might be paid later. So the transaction price may include non-cash considerations. Maybe we will pay for share-to-share exchange, non-cash consideration. That is what we are going to receive. It could be cash, it could be non-cash consideration, it could be variable consideration. It could be variable consideration. So if the transaction price is involving variable considerations, these are amounts where we say maybe they are discounts. If someone is to pay at once, they can receive a discount. So the variable consideration, it takes into account variable amounts such as discounts. So what we may receive may be affected by factors such as discounts. So we consider the expected value. If they are variable, if someone can pay, maybe if they can be given discount if they pay early, we need to consider the expected value or the most likely amount if the transaction price includes variable consideration. If it includes variable consideration, the amount to be included as the transaction price is the expected value or the most likely amount. The most likely amount. So we are saying how much are we likely to receive? So the amount is not certain, but how much are we likely to receive? Then we only include variable amounts. We include variable amounts in the transaction price. We include variable amounts in the transaction price to the extent, or we can say if it is highly probable if it is highly probable that a significant revenue reversal won't occur. So we are not sure the actual amount we are going to receive. So if we have included the revenue maybe as 20,000, but the other 5,000 is a variable amount, we should only include the 5,000, provided that there are high chances that is going to be received, or there are high chances that it is going to be part of our revenue. Because if it turns out that we have not received that 5,000, we might need to now reverse the revenue. So include it if there is a high chance that after you've included it, you don't need to later reverse it from our revenue. So include it if there are high chances that you are going to receive this money because you're the one selling. So include it provided there are high chances you get this from the customer. So if it is highly probable that a significant revenue reversal won't occur if the uncertainty is resolved, because we are not yet sure of the amount we'll receive. So just include the amount that you know there are high chances that you won't end up now need to reverse that amount. So don't include the 5,000 if there are high chances you might need to reverse it and remove it from revenue. So if there are high chances you're going to receive it, recognize. But if there are high chances or high uncertainty as to whether you receive this or not, you may need not to put it in revenue. Now, let's move on. We also said non-cash consideration. So there can be cases where someone can pay using other forms without paying using cash. So for non-cash considerations, include them at fair value. So if they are not paying using cash, include the non-cash consideration at fair value. Then, if there is a contingent consideration, maybe some of the payment can be made later. So someone has to pay now, and the balance, they can pay it later. So if the payment is deferred, if the payment is deferred, meaning it can be made, some of it is going to be made at a later date. If the payment is deferred, take into account the time value of money. When recording the amount to be received. So if we are saying we've entered into a sale transaction, how much are we going to receive? That is the transaction price. So in this case, our example was a simple one because we are going to receive $100. So our transaction price, someone is going to give us $100, and not $100, 100,000. They are buying the car brand new, and the transaction price is 100,000. That's what we are going to receive. So we have determined the transaction price. Then allocate the transaction price to the performance obligations. 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 So if you are allocating the transaction price to the performance obligations, if you are allocating the transaction price to the performance obligations, you are now sharing, because the person is going to pay 100,000. But in that 100,000, they have paid for maintenance and they have paid for the vehicle. Of course, to them, the maintenance is free. But to the organization, since someone, if they are buying maintenance alone, we are charging them. If someone is buying maintenance alone, we are charging them. If you can look at the question, we are charging them 10,000 a year. So maintenance is not it's not for free to us. We charge maintenance. But to the customer, we've given them the option to, if you buy a brand new one, we give you maintenance for free. So what does that imply now? This now means that to us, we have sold maintenance plus the vehicle, but we have discounted the two. Because in that 100,000, it's covering both the maintenance and the vehicle. So when allocating the transaction price, we share the price to the performance obligations. We share the price to the performance obligations based on the standalone selling prices. We allocate the transaction price to the performance obligations based on the standalone prices. So if you're allocating the transaction price, you say, okay, if we are selling the vehicle, if we are selling the motor vehicle alone, let's assume the price is just 100,000. It could maybe be less. That if you want the vehicle alone, you can buy it at 90,000. But if you want with free maintenance, you just pay 100. Maybe if you want the vehicle alone, is okay. Maybe let's just adjust the question there. They sold a motor vehicle worth 100,000 on the company's policy to provide. Then you can be told the option to purchase the vehicle without maintenance. Is 90,000. So if they buy with maintenance, they will get free maintenance. They will get free maintenance for 3 years. So they'll get the free maintenance for 3 years. But if they don't want the maintenance, they can pay 90 and get it. So we're saying the motor vehicle alone, that buy the motor vehicle alone without maintenance is 90. If they buy the maintenance alone, for 3 years, it's 10,000 times 3 is 30,000. So if they buy the vehicle alone, it's 90,000. If they buy the maintenance alone, it's 30,000. So it means buying the vehicle together with maintenance, it will cost you 120,000 if you buy them separately. But if you just pay 100,000 once, you'll be getting the vehicle and the maintenance. So it means when we sold the vehicle at 100,000, we actually sold the vehicle plus the maintenance. We sold the vehicle plus the maintenance. So this bundle of sale we are going to allocate the price, allocating the 100,000 price transaction price to the bundle of cells. We are going to allocate the 100,000 transaction price to the bundle of cells. So the 90,000 and the 30,000, these are called stand-alone prices. If you were to sell it alone, well, how much would you sell the motor vehicle alone? The maintenance alone? Those are stand-alone prices. So you share the 100,000 price based on the stand-alone selling prices. You share based on the standalone selling prices. So we are sharing 100,000 in the ratio 90:30. So that would be 90 over total times 100,000. This one, that would be 30 over total times 100,000. So in other words, by selling at $100, by selling at $100,000, it means you have discounted your price for the vehicle and the maintenance. If they were selling it, if you're buying it alone at 90, if you're buying it alone, you'd buy at 90 and 30. But if you're paying once, you can pay 100 and you get more. But in our selling price, to you, we are telling you maintenance is for free. But to the organization, the maintenance is not for free because we charge others maintenance. So we have two performance obligations here, the vehicle and the maintenance. How did we split to come up with the price for the vehicle and the maintenance? We allocated the price based on the standalone selling prices, which is the 90 and the 30. Now, after you have split the price, so allocate the price. We have done so. We have allocated the price. After allocating the price, what is the next step? The next step is, which is the last one, you now recognize revenue after the performance obligation has been met. Recognize revenue after the performance obligations has been met. Recognize revenue after the performance obligation has been met. Recognize revenue after the performance obligation has been met. Recognize revenue after the performance obligation has been met. Okay, what does this statement mean? So recognizing revenue after the performance obligation has been met. This means that you recognize revenue after control has been transferred. Or after the service has been provided. You recognize revenue after control has been You recognize revenue after control has been transferred or after okay, let's move. So we recognize revenue after control has been transferred or after the service has been performed or provided. Are we together so far? My team that is joining online, confirm, are we together? Hello? Okay, Paul is confirming there. Hopefully, it's the same with all of you. Okay, let's move on. In this case above, when do we recognize revenue? The recognition of revenue is different for motor vehicle and for maintenance. For motor vehicle, the revenue is recognized at a point in time. So for the motor vehicle, the revenue is recognized at a point in time. The revenue is recognized at a point in time when the vehicle is delivered. When the vehicle is delivered. So we recognize revenue at a point in time. So when we transfer the control, when we hand over the keys to the customer, that's when we are going to recognize revenue for the car because the control has been passed to the customer at a point in time when the control has been passed to the customer. But for the maintenance, maintenance is not going to be done at once. The maintenance is going to be done over a period of 3 years. So for the maintenance, revenue is recognized over a period of time. Revenue is recognized for maintenance. Revenue is recognized over a period of time. So for maintenance, revenue is recognized over a period of time. So for maintenance, revenue is recognized over a period of time. Okay. So over a period of time, what is the period of time? It's 3 years. Because you're supposed to provide maintenance for 3 years. So the revenue for maintenance will spread it over 3 years. We have sold maintenance indirectly, but we don't recognize all of it now. We spread over 3 years. We spread it over 3 years. We spread it over 3 years. So what are we now going to record in ourselves? What are we going to record in ourselves? What are we going to record in ourselves? So in our sales, motor vehicle, because control for the motor vehicle is transferred from the day we hand over the car keys. So on 1 January, if we give the customer the keys there, then the control is transferred. So in our books, we can say we have sold the car and we can recognize the revenue of 75,000. But for maintenance, so this 130 is recognized at a point in time. For maintenance, the revenue is recognized over a period of time. So if the revenue is recognized over a period of time, the revenue is recognized over a period of time, it means we are going to spread the 25,000 over a period of 3 years. So in the first year, we only recognize revenue for 1 year. So by the end of the first year, we only recognize revenue for 1 year. So that's the revenue we are going to recognize for the first year. So total revenue from this transaction, total revenue from this transaction would then be this plus that. So our total revenue will then be 83,333. So take note of that. This one is over a period of time. The revenue is recognized over a period of time. Okay. So the revenue is recognized over a period of time. Then let's move on. So what happens then to, we have recognized the 1 year revenue. We have recognized the 1 year revenue. What happens to the other? Because the customer has paid 100,000, including the 25,000. So what happens to the other amount we have received? But we are saying we can't recognize it as revenue this year. That one will be deferred income. So the one that you have received, but you can't recognize it as revenue this year, that one we can treat it as deferred income. So the revenue that you have received, that you are not treating as income this year, we can treat it as deferred income. So we can treat it as deferred income. Can I just respond to this? So the revenue that we are not recognizing this year, we can treat it as deferred income. So deferred income, we have the current liability. That is the revenue we are going to recognize in the next year. So it's more like it's someone who has given us money in advance. So the amount we are going to recognize as revenue next year, that's the current liability. That's the other 1/3. Since this was 1/3, so the other 1/3 is current. Then the other 1/3 that you recognize after 12 months is non-current. Think of the way we're treating grants, where we receive a grant and we are using the deferred income method. So it's money you've received, but you can't recognize it in revenue now. So you recognize only the portion for this year. The other portion is non-current, and the other one is the current. Okay, let's move on. We mentioned that you can be acting as an agent, or you can be acting as the principal. So if you are acting as an agent, what can indicate in the question, what can show you that this one is not the principal? This one is acting as an agent. What can indicate? You can say the following can indicate the following can indicate that the vendor is acting as an agent. Sometimes you will not be told that this one is an agent, but the following conditions can give you a hint that this one is an agent. What can indicate that this one is acting as an agent? If the obligations to fulfill the contract lies with another person. So obligations to fulfill the contract. So it's another person who is supposed to fulfill the demands of the contract. Lies with another person. So the obligations to fulfill the contract lies with another person. Then also the power to determine the selling price. The power to determine the selling price. Lies with another person as well. If you are not the one that can determine the price, then you are acting as an agent. So as an agent, you don't recognize all the sales, you just recognize your commission. If you are receiving commission, if you receive commission as part of the consideration, as part of the consideration. Lastly, if the risk of bad debts, are transferred, you can say risk of bad debts and inventory deterioration or just inventory are transferred to another person. So we might find maybe the goods may get to the person, that risk, then if it's passed to another person, you're not the one that is going to suffer as a result. Maybe if there are returns, the goods are not going to be returned to you, they are returned to someone else. You are not suffering the risks associated with the inventory. Or if the person, if there are bad debts, you're not suffering again as a result of the bad debts. Then you are acting as an agent. Then one more point that I had forgotten to add, I think let me just put it here if I forget, is when or we can go and add it to where it was supposed to be. Determining the transaction price. Determining the transaction price, or we can just add it here as an NB point. Let's just add it there. So the case I want to talk about is a case where the product is sold on a sell or return basis. So we only recognize it as a sell, provided that the conditions are showing that it will not be returned. So if the sale is made on return basis, is made as a sell or return basis, the revenue should be recognized to the extent that the goods will not be returned. So we recognize revenue to the extent that the revenue, that the goods will not be returned. So we, after taking into account factors that can show that the goods will not be returned. If there are conditions showing that the goods will be returned, we should not recognize revenue. So if there are conditions indicating that the goods will be returned, then we should not recognize revenue. We should not recognize revenue yet. Okay, so I think regarding the first part, the revenue recognition criteria, we have done justice to that. Then let me also add that we said that the standard, the revenue should be allocated based on the standalone prices. Then, if the standalone prices is not, maybe we don't have the standalone prices, we are not selling the maintenance alone, then we can estimate. So if the standalone price is not observable or is not currently available, the firm can estimate. So if the standalone price is not observable or is not there, the firm can estimate. So these are some of the questions that can come as theory questions. If the standalone prices are not there, the firm can estimate. The firm can estimate. Then we also said that revenue should be recognized after control has been transferred. What can indicate that control has been passed? Like for the motor vehicle, we recognize revenue after control has been passed. Indicators of control. What can indicate that control has been passed? So what can we use as an indicator that control has been passed? So what indicates that control has been passed? Number one, control can be passed if we are now entitled to receive payment. When we can now call the customer and ask them, what about when are you paying our money? So when we are now entitled to receive payment. Entitled, entitlement to receive payment. When now we have the entitlement to receive payment. Number two, we can have a case where now the customer has the goods. So control is passed when the customer is now in possession of the car. The car is not still with us, or maybe we've given them the go-ahead. They've said, I'll come and collect it, but now they've been given the car keys. So the goods have now been in possession of the customer. And the customer has legal title. Customer has legal title. Maybe we have given them the title deeds. They have now the legal title to the asset. So we can now say control has been passed. So in those cases, we can now say control has been passed. Then we can also close with, we have a bill and hold agreement. We can have a bill and hold arrangement. So we can have a bill and hold arrangement. So we can have a bill and hold arrangement. So this is an arrangement where the seller bills a customer. The seller bills the customer for the goods, but the seller remains in custody of the goods. Or remains with the physical possession of the goods until a later date. You can go to the rural areas and you can decide, okay, wakutenga mombe. Then wotenga mombe but usina danga rekudzichengetera. Just say, okay, I've bought this cattle. You can keep them for me. While this maybe I have arranged where to put them. So as the seller, I can agree to that. Okay, I can keep them for you. I can keep them for you. So in such kind of an arrangement, we might not have given the customer the goods. In such kind of an arrangement, we might not have given the customer the goods, but we can recognize revenue. In such kind of an arrangement, we can recognize revenue. So you can say in a bill and hold arrangement, revenue is recognized. In a bill and hold arrangement, revenue is recognized when control has been passed. So the revenue is recognized when control has been passed, irregardless of the possession being still with the seller. So let's highlight that. The revenue is recognized when control has been passed to the buyer, despite the goods remaining with the seller. So the revenue is recognized after control has been passed to the buyer, because the buyer now has control over the goods. Even though the buyer decides to leave these goods with the seller, but now they have control. If they want to take these goods, they can, because the goods are now theirs. But they've just requested that the seller keeps the goods for them while they come and collect them at a later date. Subheading, we're going to start from here in the next session. Revenue from contracts with revenue from construction contracts. Revenue from construction contracts. So revenue from construction contracts. That's where I want us to start the next session. But for today, I think we can end here. So I don't know if there are questions. So from what we have been discussing.